From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those championing market growth and anchoring the nation's economy, small businesses, and entrepreneurs.
Welcome to the Simple Numbers Profitability Playbook Podcast. No, I'm not Mike Maxson. I'm Brandon Gray. Mike is out of town today, so we've got another team member. Special guest this time, Micah Ledbetter is going to join us today for the podcast. And you guys have heard us talk about Micah before. Mike, I don't know if you know this, but we talk about you on the podcast. And so
it's
Mike,
good to finally be here.
Yeah, no doubt. So Micah's one of our consultants on our team and really has a great background, and I would say a passion for following the economy. So I think of him somewhat as our in-house economist. As far as that part goes. Don't tell Greg Crabtree we said that. But we're going to talk economy a little bit here since we've got Micah on. We're going to go through some headlines. And as you guys have heard us talk about in the past, there can be a little bit of a disconnect between what we see in headlines, particularly around the stock market and what's been going on and what entrepreneurs are experiencing. And so we're going to tackle a few of those. I'll tell you, as of late, the headlines have not looked great. And so you may come away from this with a little doom and gloom. Sometimes we get accused of preaching that or giving that vibe, but we just try to, we try to call it like it is as far as that part goes. And so we'll kind of get rolling here, Micah. So I'll throw out a headline or two and we'll discuss them.
All right.
And Micah, you can give us kind of
the
economist take on it. I'll give you the simple numbers take on it and we'll kind of see where we land. So the first one here, so this one comes from the Washington Post. Headline reads, inflation remains elevated while Americans report rising cost and low job confidence. So what do you think about that one, Micah?
Well, so we have to sometimes take a step backwards to go forwards. And what we know now for sure is the Fed is re-engaged. And the main concept they wanted to get across to the markets was, hey, in this fourth quarter, we want to punctuate the year with rate cuts. So we got 2, we're headed for 3. And Brandon, you're not going to believe this, but a 50 basis point cut could be on the table coming. And so, hey, a 50 point basis cut is actually on the table. But you know what? What they did tell us was in the trade-off, or I would say trade down, for those rate cuts was they were going to let inflation run a little bit hotter. So they said, hey, do not expect inflation to drop in the fourth quarter and through the first half of 2026. So the devil's in the details there because inflation will tick up in the fourth quarter and the first half of the year in exchange for trade down for those rate cuts.
So it sounds like the Fed may be coming around to our way of thinking in terms of you're not going to be able to fully control inflation with interest rates and have a robust economy.
Yes. And so, think about it, Brandon. Think about it this way is a great way to frame it. The Fed interest rate policy is a blunt force instrument. Mm-hmm. It's going to affect everything in one way. So, inflation, and they haven't really updated their ways to attack the economy. So labor's on one side, inflation's on another side. Got some ideas about how it will go, but that's the conundrum we're in now.
So simple numbers application. If you're an entrepreneur and, you're kind of reading the tea leaves, I believe the Fed meets the 28th, 29th of October, something like that. I don't think they'll go with a full 50 points, but we'll see. But nonetheless, the writing is on the wall. And I think all of our clients have been experiencing inflation probably closer to 6%. Than the 2 to 3% that we see published, because we're just looking at total cost increases when we look at that 6%. So if you are a simple numbers client or an entrepreneur, the writing's on the wall, you got to look at pricing. And so what we're seeing in a lot of cases is not necessarily that you're seeing wage inflation. I mean, it's present. Don't get me wrong. I mean, folks every year expect what? They expect a raise. So you're going to continue to see a little bit of wage inflation, but the labor market is fairly soft. We're going to talk about that in another headline here in just a second. But everything else in your business is likely going to continue to rise. there's an article this morning I was reading about the cost of insurance and how some states now are looking to put caps on policy premiums, how they're looking to put caps on increases. Of course, we've got the bill out, and with the government shutdown and what have you, about the fate of Obamacare and some of the tax credits there and what that could do for health insurance. So that insurance is just one of them, but it's a pretty big one for a lot of clients. But everything, just think about it: travel, dues, subscription, supplies, materials, the little things is kind of death by a thousand cuts. We need to make sure we're monitoring our overhead increases. And, we're going to pass some on in terms of pricing. And I think that the stage has been set in terms of the tariffs and what now, I think it was maybe Goldman Sachs, and forgive me if I got the firm wrong on that one, but released a survey that consumers are now burdening about 55% of the tariff costs that are flowing through. So, Merry Christmas, everybody.
Yeah.
Next stop.
Hey, Brandon, I've got another stat. Hey, I got another stat, man. So I follow what I call trueflation, and it's going to be exactly what you're talking about. In real time, it monitors 3,000 items, not the Fed's preferred items. 3,000, about 5.74 is the true rate of inflation right now. So there you go.
Simple numbers,
right on those numbers in 5.74, and that's predicted to stay in a range 4.93 to 6. So, just call it 5 to 6 is where we're looking to stay for the short to medium term.
So the last part of that headline, and this kind of leads us to our next topic: low job confidence. So 47% of adults are lacking confidence in their ability to find what the article states as a good job. So, Micah, kind of what's your take on the labor market?
So this morning I was looking on CNBC, and they had the Carrie Bradshaw Index. Okay, I'm gonna dig deep in my bag of tricks. How affordable is it to live on your own right now in the country? They couldn't come up with 10 places on an average income to actually live on your own comfortably. So I think for the job market, that says it all right there, right? The jobs are not keeping up with the pace of inflation. The Fed's beige book came out, and they used the word modest about 30 times in their word cloud as far as the labor market goes. So it's a tough grind out there right now, I would say.
Yeah, I would say what we're seeing with our client base is when you got a handful of things. And so the first one is, everybody listening has likely heard our stance on, in the current marketplace, you have to get profitable with what you have, meaning the level of gross margin dollars you're generating. And so for a lot of folks, that's meant reductions in labor cost. You can cut office supplies all you want, but it's not going to get you to profitability. So you've got to attack labor. So you do have quite a few clients who over the past year and a half to 2 years have been restructuring, lowering their labor costs and what have you. You've seen, we kind of had this huge demand for labor right after COVID. And, folks were hiring before interviewing, trying to meet the demand. You're seeing, a lot of those folks now have kind of found their way out of a company because they were not an A player. The second kind of move we've seen is that as people leave, they're not being replaced. And so margin dollars are down, activity's down. I was on a call with a client last week, and they said, okay, we've got a person that's leaving, and we're going to absorb their tasks amongst 3 other team members. And so you've got to make sure when you make those moves that your team is focused on working in their highest and best use. And what we mean by that is, there could be a report that they were generating every Friday that took them 2 hours. Well, is that their highest and best use right now, given that they're taking on additional responsibilities? So maybe, may not be, but you got to look at what they're doing and help them understand where they need to most effectively spend their time so that you can keep the main thing inside your company. Then the third thing we're seeing when it comes to labor, we're advocates of flexible labor cost. And so hey, everybody's going to get 40 hours or everybody's going to get 45 hours, regardless of role, regardless of activity. Some businesses can pull that off, but generally speaking, that can be really difficult, especially if you have some seasonality. And so we're seeing clients really kind of challenge their operational managers on, hey, we need to make sure our labor fits the current level of production. And if we're slow, it might be 32-hour work weeks. If we're really slow, it could be less than that. If we're busy, it might be 45-hour work weeks. And so it's very akin to what you see in the construction sector. I had a buddy that was in construction, and he would say, boss man would say, "Hey, sorry guys, we don't have work. You're gonna be off for 2 weeks." They go draw unemployment, and then he'd call 3 weeks later, and he'd say, "Hey guys, pack your bags. We're gonna be working 7/12s for the next 3 months." Just that up and down, up and down, and in most companies it's not that violent of a swing, but all of that adds up to less take-home dollars when you make those adjustments. We know inflation's high. And so life on the home front can be difficult. So Micah, kind of what are your thoughts in terms of consumer spending?
All right. So I'm going to start first with what you're talking about with labor, because from the company's perspectives, they would call that right sizing.
Right.
From the employee's perspective, they would call that downsizing, right? So it's the same word that's going to produce the same result. I'd like to know what you think about this. I've heard a lot of people saying, hey, some of this, the AI related layoffs are just due to flat out right sizing their labor force. What's your opinion on that? Because we've seen a lot of companies use the AI as a reason to right size, but is that really not AI, but just, hey, we're just continuing to get our workforce in tune with the current market conditions?
So I would say, as we talk to our clients about their use of AI, it's all over the board. And generally speaking, it's still a little bit more of an experiment and a kind of an add-on feature, you might say, a nice to have. I've seen a handful of times, especially around things like call centers, to where AI is truly replacing labor. So there's a handful of cases to where, you could say, yes, this job did truly go away because of AI. I think in more cases, it is the right sizing of labor. And as they're doing the right sizing, they are experimenting with how to use AI for certain roles, certain tasks, and what have you. And you'll kind of see this cross point to where they are able to use AI to where the next growth wave they have, they're not going to have to add back the labor that they just let go, that the AI will take care of some of it. And, I think you guys have probably heard Greg Crabtree say this, and I think he stated it very well. He said, here's the problem with AI. Yes, it's great in terms of efficiencies. It's great in its ability to perhaps reduce labor costs. Don't get me wrong. We want to use it, embrace it, all of those things. However, AI is not a consumer. AI is not purchasing anything. And in order for the economy to flow and function, you have to have consumer spending. I come across an article this morning that was talking about luxury brands and how they're starting to see a decline in sales. Pretty much all the retailers are saying, hey, consumer spending is low. We're coming into, Black Friday, Cyber Monday's right around the corner. And, we kind of have an emergence here that's a little bit different than what we've seen in the past around holiday season. In the past, it was typically, hey, we're going to run discounts. You're going to get that 65-inch flat screen TV for $299. And there's probably still going to be some of that. But also now what you're starting to see are retailers going, we're not going to be able to do as much of a discount because of the tariff cost. And so if that kind of flows through, you've got a holiday season here to where between inflation and tariff cost and whatever label you want to put on it and lower paychecks at home, what do you think that could do in terms of the outlook for retailers and their Q4 earnings?
Hey, this is a great, because I brought with me today, our friends at Adobe said, we're going to outline holiday spending and holiday employment. Holiday employment for part-time workers, people looking to take on that second job, are going to be down to the lowest level since 2016. So companies are not adding those people. And the corollary to that also is holiday spend is expected online, which will be the majority of the spend, about 5.8% year over year, but that's down from 8.7 last year. So I don't think Christmas is going to be the bailout for the retailers that they had in years past. And when we talk about those inflation adjusted profits, Brandon, 5% sales growth with 5% inflation, you're just moving the chains. no
Yeah.
real progress.
Well, we're full of good news, right? I mean, everybody's excited. So simple numbers application here. What do we do about this? You know, data's great, information's great, but only if you put it into practice. One thing that we are seeing with our clients, that whether it's in retail, B2B, B2C, on the service side of the house or what have you, the ones that are getting ahead and are succeeding are being creative. And so they're bringing something new to the table. I've got a online retail client that does some in-house manufacturing as well. They're releasing different and new products. And when I say different and new, it's not, they're just putting a different color on it. It's something brand new that you don't have, that they're bringing to the marketplace, that has an appeal to it. And I think you got to take that play and you've got to apply it to your business. You know, what's a service offering that matches the current need in the marketplace, that falls right in line to what you guys deliver that you're currently not offering? How do we modify or add to what we're currently doing? What are new products? What are innovations? What are things that we can bring to the table, knowing that our clients, our customers, and what have you are tight whenever it comes to profitability, and discretionary spending. What can we bring that's going to kind of allow them to take a little bit of a risk and go ahead and move forward with the purchase? And it could be as simple as, I've got some clients that have normally had like 12-month contracts. They're going, I'll tell you what, sign a 3-month contract. That's going to help cover some of our startup costs in working with them. And I'm pretty sure that once you start working with us, you're going to be really pleased and happy, and you're going to want to continue. And that's a simple one, but I do think it is an open invitation for being innovative and being creative, to find a way around this. Micah, any thoughts on that?
Yeah, I mean, so straight from the beige book. So the Fed puts out the beige book, 8 times a year, and their exact words were, discretionary income, as you said, is under pressure, and households are trading down to find value. So I think it ultimately always comes back to meeting your customers where they are at that any given time. And so we've seen that over and over again. So yeah, those creative ways to drive traffic and the creative ways to make a sale. And hey, how many times have we seen the in-person stuff now completely overtaking the online stuff? The grip and grin, the personalization selling is tend to drawing the marginal dollars right now. I mean, we talk a lot about Sean Bussey, on over the years, have been a great friend of Simple Numbers. He had a great post on LinkedIn. He said, hey, look, he's probably one of the digital marketing kings. He said, right now, direct mail is meeting the customers where they are. And he actually posted that on LinkedIn. So there are ways to find those clients and customers, but they may not be as simple as they were the past 5 years.
No doubt about it. Yeah, I would say along those lines too, you mentioned the face-to-face. I've had calls with clients who, their outbound sales team, their BD team, they're behind their keyboard sending emails. And not to say you shouldn't send emails, but in this case, the client had pretty much a quota, you might say, on in-person meetings each week. And, we're talking on their monthly calls, and I'm going, all right, okay, what's Outlook? What's the days to close? What does pipeline? What are proposals? Just getting a feel for what's going on in their environment, which will help us as we do their forecasting. And they shared with me, they said, it'd been down the last couple of months. And they said, so we got to digging into it, and come to find out, very few of their members on their BD team were doing what they were supposed to do, which was lunches, dinners, meet people for coffee, being out and about, gripping and grinning, just as you mentioned. Believe it or not, I know this can come as a shock. Once they really held people accountable to getting out of the office and being in front of people, guess what happened to proposals? They went up. Sales closed. They were closing quicker. So yeah, to your point there, Micah, makes a big difference. We got one more that I want to hit you with. This one's a curveball. Before we wrap up, outlook for 2026. So you're an entrepreneur. It is October of 2025. We're in Q4, almost a third of the way through it. You're doing your annual planning with your team for 2026. What should entrepreneurs expect? Will we see a rising tide that lifts all boats economically.
For sure in the first half. I think the first half still looks good. There's a general line that you want to think about monetary policy, and it really works the same way every time. And it goes a little something like this: 1 to 2 cuts move psychology, 3 to 4 move liquidity. So we're still got to get to that third rate cut till we start to see the liquidity move. So I think they're going to backload those rate cuts to give us some more liquidity to the first half of the year. And remember, Brandon, the 250th year anniversary of Old Glory is in 2026. So I'm expecting the economy to hold in there for sure through the first half. The headwinds will remain the same. Inflation adjusted profits will be a little under pressure. Pricing will be key, as always. And I think back to what we always talk about, it's a street fight economy, which it always is, unless there's a ton of liquidity in the market. So I think the first thing you should look at is, hey, is my pricing correct? We know about 5 to 6% is our inflation adjusted number. Getting profitable with what we have, using AI to augment our direct labor teams. I think the sales will hold in there at least through tax day, but the back half of 2026 could get a little more murky.
All right. So I'm going to give you my take. I had you go first on purpose, since I'm getting to play the role of Mike Maxon. See, this is what he does to me all the time. So I'm going to have a slightly different take. Not totally different. We got a lot going on in 26. You got a midterm election taking place. We're likely going to come off a holiday season that is not gangbusters in terms of the data and what's being reported. We will or should have additional rate adjustments, as you mentioned, to help with liquidity. So I think that we will see improvement in 26, but I think it's going to take a little bit longer than the Q1, maybe into Q2. And here's why I kind of say that. There's sectors of the economy that have been dormant now since middle of 2022. You look at the housing market, real estate development, construction, and large consumer purchases around automobiles and those kind of things. Anything that has interest rate sensitivity, right? It's going to take I think it's going to take a little bit of time to see all that triculate through the economy to where, if I'm a developer and I'm planning a shopping mall or a shopping center or what have you, and you're watching the interest rates right now, you probably have, you've already done perhaps even the dirt work, and then you put it on hold. Or, we got a demolition client. He said more than half of their teardowns, and this is crazy, more than half of their teardowns currently do not have a new building going up after the teardown. So, you may have done the demo work, you're ready to roll, but you're watching the interest rates until it pencils out to where you're like, okay, we can lock in some financing. Also on the other side, you've got a large amount of PE activity still taking place, but you have a lot of companies who have not been able to turn the companies that they bought in 2019, 2020, 21 because rates have been high. So they haven't been able to turn them for that next person to get the financing to go purchase them. So I say all that to say, I think as rates come down, you'll start to see the flow of activity. And then hopefully that turns into some improved consumer spending as we get into the latter parts of 2026, and we start to see a little bit more functioning economy. So we'll see. I hope you're right. I hope it takes place soon. I'm tired. I don't know about you. I'm tired of getting on calls with clients and their dashboards all red. So we need a change, brother.
Yeah, I think we're going to hold in there that first part, because remember, price increases come in the majority of the year in January, February, and it typically peaks out in April. So I do think we're going to get some more pricing in there. The question is, will that consumer be able to absorb it? That's going to be a call for another day.
Yep. Good stuff, Micah. Good job with your first Profitability Playbook podcast joining us. So we'll have you on again in the future. Man. It's much better talking to you than talking to Mike Maxon. See, Mike picks on me, so he's not here. Right? So all of our listeners, you guys need to bombard Mike with this one. Do me a favor, shoot Mike an email, message him on LinkedIn, and say, "Hey, hate that you weren't on the podcast, but it was one of the best ones we've had." Okay, so let's, you got to bring Mike's ego down a little bit every now and then. But thanks again, appreciate you joining us, giving some insight. you guys know if you've got questions on anything we've talked about, feel free to reach out to us, ping us. We're also doing a lot of 2026 planning for clients right now. So if you're interested in that and not a client, hit us up. We're more than happy to talk about some things that we can do, and we can even customize a session for you guys that are podcast listeners for your 2026 plans. So for Micah Ledbetter, I'm Brandon Gray. Thank you for tuning in.
Until next time.
If you want to know more about driving sustainable profitability for your business or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Spotify, Apple Podcasts, or wherever you prefer to listen to podcasts. If you like what you heard today, please leave us a review. This podcast is brought to you by CRI Simple Numbers LLC, a division of CRI Capital Group LLC, and a subsidiary of CRI Advisors LLC. CRI is the trusted brand under which Carr, Riggs & Ingram LLC, the CPA firm, and CRI Advisors LLC, along with its subsidiaries, deliver professional services. Please note, Carr, Riggs & Ingram LLC is a licensed independent CPA firm offering attest services, whereas CRI Advisors LLC and its subsidiaries specialize in providing tax and business consulting services. These entities operate within an alternative practice structure as defined by the AICPA Code of Professional Conduct and comply fully with applicable laws, regulations, and professional standards. Ready to simplify your business finances and drive growth? Explore valuable resources, books, and tools designed for entrepreneurs and small businesses at simplenumberscri.com.